Ravi, hi, good to have you with us. How have you been?
Hey, thank you, Ashu. All well, plugging away.
Ravi, this is an exciting conversation, right? I mean, we are, the timing couldn't have been better, right? We are amidst massive liquidity surge, right? I mean, I think startups are getting funded every single day. I mean, the time couldn't have been more perfect in that sense, right? From a liquidity standpoint, right? And for innovation, I think, with what we've seen in the last about a little over a year has been absolutely phenomenal, right? And thus this makes it a very exciting conversation in that sense. But Ravi, before we dive into that, right, I'd love you to take us through some of the great work that you're doing. A quick round of introduction will be helpful, and we start from there.
Sure, sounds good. Ashu, I have about 13 years of experience, 3 years in tech. This was tech back in the day. I was at a startup, which was actually a value funded startup, business school in the US. And then last 11 years, I've been on the financial services side, spent a year at Ernst& Young, sort of cutting my teeth at investment banking,
Right.
and then moved on to private equity. Spent the next 5 years doing private equity growth capital deals, all the way from $7 million to $35 million deals.
Right.
Was on the board of Equitas when they IPO'd. Led the investment renewal, which we sold to Tata Power.
Interesting.
And then in 2016, I partnered with Manish, who was getting out of his position at Providence Equity Partners, to sort of set up WaterBridge Ventures.
Right.
We're an early stage venture capital firm. We do early stage tech. I think a couple of things that differentiates us from the others is, one is we do few deals, we don't do a lot of deals.
Right.
And second is we go really deep in those deals. We are very hands-on. We add value to our founders.
Right.
And over the last, let's say, 5 years, we are investing across two funds, 24 companies. Some of our investments you might have heard of: Unacademy, Doubtnut, Magic Spin, Zip Loan, Chalo, BitClass, City Mall, Business. So yeah, that's sort of very quickly who we are, what we do, and my background.
Interesting. Ravi, I'm gonna talk to you more about the portfolio companies that you have, and I think some of them are extremely interesting, right? I mean, I've had the opportunity of knowing the founders, talking to the founders, right? And I think one thing that is definitely a constant, which I think is also very critical, is the founders who are running the business, right? And I'm going to talk to you more about the founder thesis and so many other things, right? But before I do that, right, I mean, tell me a little more about the fund, right? I mean, tell me a little more about the construct of it, right? You've given me a flavor in terms of you have a tech bent, right? When you're investing in these companies, give me a sense of which are the sectors that you look at, right? Or is this a sector agnostic fund, right? And
So,
I think the other thing that I would want to understand is, how do you prioritize, right? When you're looking at a company, right? So I think a little bit of a dissection of that will be helpful.
oh, fantastic. So we are an early stage venture capital fund, sector agnostic, but very, very focused on tech disruption across sectors. We are sector agnostic. Of course, we have our favorites, and edtech, fintech,
Sure.
consumer internet definitely are some of our favorites, and we've had our best successes there as well. But we've also had great successes in B2B and SaaS.
Right.
I think the way we think about investments is fundamental tech disruption in some of the core sectors that we sort of operate in, and we look for companies and founders who are bringing a very, very unique perspective to some of those sectors. And why should tech disruption really make a difference, right? And your second question was in terms of what do we look for in founders?
Yeah, I mean, so how do you look at it? I mean, what makes you select a company A over a company B, right? I mean, what are those early parameters that you would look at when you're making these investments?
Sure. At the seed to Series A stage, obviously we have a strong sense on the sectors, the market opportunity, the market size, and what could possibly happen. I think we over-index a lot on founders. We really spend a lot of time understanding the founders. What is their opportunity cost?
Sure.
We are strong believers in the horses for courses philosophy, where certain horses fit and really succeed. So certain founders really do well in certain sectors that they found in, that they operate in, and we look for that kind of fit, right? We also spend time understanding what are the unique insights that they bring. Why do they have the right to win over any other founder in the space, and what is their unfair competitive advantage? And that could be anything from prior experience in the sector, having spent a lot of time, family businesses in that sector, and hence there are some very unique insights which somebody else might not have, or the ability to build a strong team, right? Any and all of these could give them unfair advantage. And as you can see, that a lot of time is spent also on understanding founder dynamics, right?
Right.
How many founders are there? Who does what?
Mm-hmm.
How is the shareholding split between the founders? Is there a CEO? Is there a first among equals?
Right.
And we synthesize all of this with our own experience of. I would have personally met or interacted with at least about 3,000 founders in the last 5 years.
Mm-hmm.
We synthesize that, marry some of the macro with the micro, and when we think there is a fit, we then sort of bubble it up internally to our investment committee and then take a decision.
Ravi, that's a very,
in a very short answer,
that's a very complex process.
It's complex, yes. But it's also something that we have been doing for a long time, and hence we try and optimize the process as best as possible.
Right. Interesting. Ravi, you spoke of tech-led businesses, right? And I think I mean today when you talk to and many investors, right? When you look at the landscape, right? I think a large part of them essentially are tech focused, right? Now, and this is a question that I have for you, right? I mean, and given that you invest, see, I mean, when you're looking at tech, right? I mean, it's essentially the possibility of being able to replicate it, right? So between say a team A and a team B, I'm saying, we're taking out the founder side equation out of it, right? But between a team A and a team B, tech is possibly a 3-month, 4-month, 5-month, 6-month sort of an arbitrage, right? Unless you're doing a very deep tech, IP-driven tech, right? I mean, is that part of your thesis? Is that something that you look at, or you're more focused on say the delivery side of it, saying that blended with the capability of team is and say certain unfair advantages that you spoke of, right? Could give them a heads up, an advantage where competition could only possibly look to get closer to them over a period of a year and a half, right? And that's a large enough arbitrage for them to go out and acquire customers, right? I mean, what does that combination look like? And I know there's no very clear answer to it. It's there is a lot of subjectivity in that process. You have to. There's a risk in the process, right? But I just want to get closer to the concept, right? I mean, I want to get closer to how do you, for example, when you're making this investment?
Let me sort of distill that into 3-4 key things. I think the way we think of tech, and you're right, most businesses have tech today, but I think the way we think of tech is, does this allow them to scale in a non-linear fashion, in a very simplistic way, right? And if we believe that this company with the tech that they're building has the ability and the potential to scale non-linear, that possibly is the biggest asset test for us in terms of tech disruption.
Okay.
And a lot of companies may or may not fit that criteria, right? A lot of them have tech, but they don't necessarily non-linear scale. Right? A lot of them could have tech which optimizes their back-end processes, which is fantastic. But ultimately, as VCs, we are in the business of investing in companies that can scale rapidly.
Right.
And if we don't see the ability for them to do that, we typically don't invest. Right. I think that's one. The second is in terms of how do you marry that with the team, right? I think it's the ability of the team to sell a vision to us that, listen, this is the opportunity I'm going after. We're the best team for it. This is where competition is, and this is why we think we will win. And this is where tech fits all in. And if all of that marries into a sort of cohesive story where there is a meeting of minds where I buy in to the founder's vision, and so does the fund, that's when an investment happens, right? And a lot of cases, the space might be hot, but I will not develop conviction on the team. Or there are cases where the team is fantastic, but it's not really a tech business. At least in our view, it's not a tech business. And hence we may not invest. So I think does that answer your question?
It does. I think we get closer to that. But I like I said, there's no right or wrong answer to it. I mean, you just get closer to, I think the entire possibility, right? Ravi, I have a follow-up, question, right? To what you said, right? I mean, you mentioned scale, right? I completely understand, right? In an environment like the one we are, scale is very, very important. I mean, that's essentially what, gets you the exit and, gets a larger valuation, so forth, right? Now, when you talk of scale, right, there's something called a market maturity where, you have a customer which is ready to consume something, right? And on a lot of occasions, you have to basically incentivize a customer to get to a point of habit, right, where they start to consume in a more consistent format, and then that is a traceable format, right? Are you one of the players when you are funding? Are you willing to fund that that behavioral change, or are you typically playing in games that you think the trend is already set, right? The behavior is already set. We're not really necessarily going to go out and burn capital to sort of change that behavior, right? Which is how do you prioritize between these two?
Sure. No, good question. I think the way we think about this is behavior change versus what are they disrupting, right? And that's a fundamental dichotomy there.
Yeah.
I think today, do we believe that people are willing to consume all kinds of services, products, content online, and hence there is, yeah. So I don't think that behavior change is something that uh, we will we will fund, right? Because we don't, if things are moving online. There is people are going on the tech sort of trajectory very quickly. I think the catch really is when you're disrupting an industry, where are you inserting yourself in, and how are you disrupting? If we believe that there is a massive latent demand for what you are making available, whether it's a product or a service, if there is a massive latent demand, and if you're adding value to your buyer, right, that's whoever that buyer is, whether it could be an individual or a company, and that value could be you're making his life easier, you're saving him money, you're doing both, you're boosting his bottom line, right? Anything which adds to that value and hence is a core requirement for the buyer is something that we will fund.
Right.
If it's a nice to have, we will not fund it. And a classic example for nice to have is EdTech, right? Where content has become a commodity.
Right.
There are so many players out there that if you have a core EdTech offering that a student is consuming, and then you have something else which is nice to have, the odds are that he or she will hardly spend any time on the nice to have value prop, and they won't pay for it. So we won't fund an investment which we believe is a nice to have for the buyer. But we believe that this is core to what they do, this to their existence, and it adds value to their life, and hence at some point they'll be willing to pay for it. We're willing to take a bet on it.
Interesting. Ravi, you highlighted a sector which is, kind of, which has seen a huge upsurge in participation, right? I mean, this was a sector which I think nobody was even touching, right, before 2018, even until 2019, right? Nobody was touching, besides, check out a few deals that were happening here and there. And I think there were clear leaders that were established in the process, right? But I think we've seen a flurry of investments that have happened, especially in the 2020 kind of an environment, right? And I think I'm going to pick up EdTech as a sector, right? And I'm trying to, and essentially we'll try to get to my point, right? And there are aberrations. For example, 2020 has been an aberration, right? COVID has been an aberration, which disrupted everything that we built in the last 100 years, right? Now, when that disruption happened, right, the assumption was that this is something which is going to change how consumers are going to consume forever, right? And that's the reason the money moved in, right? What has now happened, right? The forces, as soon as we sort of the condition normalized, as soon as the possibility of going back came into being, Indian audience was back out in the street, right? There was a huge pullback which was there. The other part is that there was a huge amount of investment that had already gone in, right, in terms of creating that infrastructure. There was an incentive for them, for to ensure that people come back and consume them, right? What happens to investment in a situation like this, right? It was a moment, it happened. Now there's a huge trace back. The trace back is on the consumer side. The trace back is also on the competition, which has actually gone out and made a lot of investment, right? What happens to the calls that have been made in under an assumption that this is something which is here to stay? What are your thoughts about that?
I think what's happening, especially in EdTech, is that you have the big three of Indian EdTech, and we believe we have a fairly nuanced view in EdTech because we were early investors in Unacademy, in Doubtnut, now in BitClass. And I think what's happening is that the big three of EdTech, which is Byju's, Vedanta, and Unacademy, have garnered what 90% of the capital has gone into the EdTech sector,
right.
And that's resulted in a spate of consolidation, right? They're buying up companies, small, large, medium, big, anything that's available, which could either be competition for them or complementary to them, right? So that's what's happening in EdTech. Obviously, what's happened in the last 3 years, especially the last 18 months, is that valuations are far ahead, especially in EdTech in terms of reality. And eventually, it will catch up with execution. And when that happens, the real high quality differentiated value propositions will separate themselves from the companies who were able to raise money because the markets were hot, because it was euphoric. But then the reality is that there is no PMF, there is no product, there is no execution, and they will eventually die or get consumed by a larger EdTech. And that's what's going to happen. And what we also need to remember, specifically in EdTech, is that you will always have multiple companies in each subsect. Because the nature of the business is that every single learner, whether he's a K-12, he's a test prep, he's an experienced person, everybody's learning needs are different. everybody needs different kinds of content, different kinds of product, which means
Right.
that automatically lends itself to a variety of companies operating in this sector,
Sure.
right? Which is why I believe that in EdTech, there can be multiple large companies based out of India because because the market opportunity is so large and there is enough and more way to create and differentiate your product.
Right.
That also means that you need to be very, very sharp in your value prop and really double down on that. And that's the key. And most companies will struggle to get to that point.
And do you think that's true for the larger ones as well, or are you when you say that, you're essentially saying that as an observation about the overall industry?
Look, that's true for larger ones as well, right? Because, but also what happens in a sector like this is that capital also becomes a moat.
Right.
When you have capital, and we have seen Byju's do that, they have added 3 other legs to their business through their acquisition, right? Which means that now they're probably the market leader in each of the segments that they operate in.
Right.
And capital becomes a moat over time, right? What capital doesn't do is capital is a moat for competition, but it's not a moat for business. If you don't have a fundamental strong business model in some of the emerging sectors in EdTech, eventually capital will run out and you will die. And that's just the nature of the way this works.
Well, I think also the fact that, I mean, just talking about EdTech, I think a lot of them are kind of re-strategizing, right? I think if you look at the recent developments that have happened, right, across portfolios, is that now they are also building physical capabilities, right? And there are models which they're kind of diversifying, which are very physical in nature, right? Which is very antithesis to what they essentially started out with, right? I mean, the starting out was essentially advocacy of digital education, right? But I think they've also understood that the market is going to go back, it's going to trace back, right? Indian consumer and many other stakeholders that are there in the sector are looking for, they will not let go of physical, right? Which essentially means that you have to build those capabilities very fast, and that possibly will result into better cash flows as well, which will help their narrative, right?
Ravi, it's not just about the market. Sorry, it's just not about the market going back to physical. I think it's about giving an omni-channel offering to your end segment, right? It's giving you that opportunity for them to consume your content and your services, whether you're physical or online or both, right? And I think that's where a lot of these players are going after, which actually totally makes sense because it's not just about consumers. You'll realize that whether will people stop consuming EdTech content just because physical is open, I think we'll only wait and watch what happens. I think the reality is somewhere in between, where they will consume both, and that's just the nature.
I agree with what you're saying, Ravi, but my thought is, and my sense is, I think physical is only gonna improve digital, right? I think the enablement and the thesis that was sort of being communicated, which is built, right, that digital is gonna lead into pretty much everything, right? It's gonna be the it's going to lead the way, right, for future learning. I think physical is going to be an important part of it, and I kind of agree with you. But my sense is, I think the kind of the nature of the market that we are, physical will lead digital, right, and it will possibly lead into higher ARPUs as well, which is otherwise a huge problem for many of the players, right? I mean, unfortunately, it's not being spoken about, but I think there is going to be an issue as far as that is concerned. But Ravi, I mean, we're not going to make it, a conversation which is on EdTech, right? I think we're going to take a step back. But do you think a similar similar environment exists for many other calls that are being taken? I mean, India is fundamentally a market, right, where you need to have a physical angle to what you're doing. I mean, we've seen that across, right? I mean, there have been digital companies which have actually gone out on scale, right? And at a later point, they've gone on and created physical infrastructure, right, which possibly became, from a delivery standpoint, from a moat standpoint, from a competitive standpoint, from a longevity standpoint, right? Do you think this is an important piece? Maybe not early on, but eventually, this is something which is going to become important as we go along.
Definitely, right? Because, and I feel like we are in 2015, 2016 all over again, where there's a lot of capital coming in, a ton of business models existing, new are getting funded. Right. And obviously today valuation is far ahead of execution. But eventually execution has to catch up, right? Sure. Especially as some of these companies start to mature. And when execution catches up, that's when the reality will separate from some of the other sort of, how do I say, speculative investments that may have happened. And I think that eventually has to happen. It's just the nature of capital markets anywhere in the world. And we will see that in India as well. I think the key is when will that happen and how? It's not if.
Interesting. Ravi, I'm gonna move towards the portfolio, right? I mean, you have a very interesting portfolio. You have some absolutely incredible companies which are in your portfolio, right? And you actually participated in them very early on, right? Why don't you take me through your portfolio? I mean, I'd love to hear some stories,
Sure.
right? Some interesting ones.
Yeah, sure. So for instance, I think I'll talk about business maybe, which is a very fresh one. It was our first investment from our second fund.
Right.
And that's a B-commerce, B2B e-commerce company
Mm-hmm.
in the footwear and now in the apparel sector. Massive, massive opportunity. We invested in them because, and I had sort of been tracking them and known them for over 2 years
Right.
from their very seed stage. So I've seen
Right.
them sort of evolve over time. I think why we invested in them is because we believe that the founders have come from family businesses that operate in these segments,
Right.
and they had some incredible and unique insights that we hadn't heard from any other team. I
Mm-hmm.
think the second is they're probably one of the most data-driven decision-making companies that we possibly have in the portfolio.
Right.
Incredible amounts of data that generating B2B commerce, but they're very, very clear. They are founders first, they're factory first. They have a very, very strong focus on supply because they believe that if you have high quality supply with strong share of wallet with the supply, there is a massive latent demand and demand will come and buy. Right?
Right.
As long as you fulfill the four vectors of price, quality, convenience, and variety, as
Right.
long as you fulfill those, demand will come to continue to come and buy. And they've scaled very well. I think we invested in the pre-Series A stage. They raised a Series A from Sequoia and Matrix, and now they're about to close their Series B from a very large established venture fund. So very excited about that company and how they're
Right.
scaling.
Right. Interesting. And you have a bunch of others as well. I mean, you have businesses you mentioned about, and of course you have Doubtnut, right? An Academy, right? And like I said, you were very early into them, right? I
Sure.
mean, tell me a
I
little
think
more about that.
Dot is also a good example, right? Because again, right? Again, over-indexed on the founders. The husband-wife combination have spent a lot of time at it. They had an offline coaching institute,
Right.
in which they really understood how
Mm-hmm.
the job of educating students works.
Right.
And during that process, they realized that most of the classes are actually spent on solving doubts than the actual lessons,
Right.
right? And they realized this is a key need for students in their learning journey. So they started off building out Doubtnut, which is a doubt solving app for students.
Mm-hmm.
Now, prima facie, one would imagine that, yeah, it solves doubts, right? What is the catch? I think the catch is as follows, right? One, in EdTech, if you're spending money acquiring students,
Mm-hmm.
then you're competing with all the big boys, which means
Right.
that it's going to be incredibly difficult for you to acquire and make money.
Sure.
They were acquiring students 100% organic, right?
Mm-hmm.
And the key for that is because when you're a student and you're studying, right,
Right.
during your education process, you have a doubt, you
Mm-hmm.
have to solve that doubt there and there, otherwise you can't go ahead,
Right.
right? Which means that the use case becomes so critical. I need a solution now. I can't wait tomorrow. That's one. Second, I'm going to have multiple doubts as I keep studying, and hence you're building a repeat use case for that. Now,
Right.
imagine a situation where you solve that process of solving doubts through technology, right? I take a picture of the mathematical equation. I have my ever-growing database of video solutions across languages is growing. So as and when people submit more doubts, I have more solutions, and there's a virtuous cycle of network effects,
Right.
and it just keeps growing. And now you become so strong. You have high engagement. You have zero acquisition cost. I can start building other stacks on top of that to monetize my audience.
Right.
And that's exactly what Doubtnut is doing. And we were the first institutional investor in Doubtnut, and it's been a very exciting and enriching journey. But again, all kudos to the founders because they have been able to navigate and grow along the way.
Very interesting. Ravi, I'm going to talk a little about COVID, right? I mean, COVID is kind of, we touched upon it, but I'm going to specifically ask you, right? And this is more on the consumer side of things, right? Um, you know, COVID is, been an unreal situation, right? I mean, none of us anticipated something of this sort could happen, right? And kind of locked us up, right? In within the four walls of our households, right? And we had nothing much to do, essentially just to consume content, right? Now, what that has done, and this is a question that I've been asking many founders and also investors, right? What it's done is it's just as an economy, it's just thrown us into a very different kind of an environment, right? An environment where we have massive exposure, right? I mean, the arbitrage between our markets have gone down. The homogeneity that we kind of struggled with, right? We can start to see reflections of that, right? But what it's also done is it's complicated us as an economy, right? Because now companies that could possibly have a life cycle of products that would have a life cycle of 3, 4, 5 years are going to have a much shorter lifetime, right? We'll
Mm.
essentially you're going to be many fads that are going to fly, right? Which I believe is going to make any investor's job far more complex because a trend that you're betting on now might not survive within that, say, a year and a half time or 2 years time, right? How do you dissect this situation? I mean, has this changed your thesis in a certain form and way? Because the consumer that we're talking about is a very different consumer today. I mean, it's a far more aware consumer. Like I said, there's little arbitrage. Exposure is very different, right? And the markets, a tier 2 market is also behaving like a tier 2, tier 1 market, right? And at least aspiration is there,
Yeah.
right? What are your like I said, right? How are you dissecting this entire change?
I think no, good question, Ashwin. I think the way we think of is COVID has had negative impact on a bunch of companies, especially on the lending, financial services, etc.
Right.
And those companies have struggled to sort of come out of COVID. But
Sure.
it also has accelerated digital adoption and tech adoption across a variety of segments, right?
Right.
Um, I think as investors, we always take a 5 to 7 year horizon.
Mhm.
So which means that to your question that listen, like for instance, if do we believe that post COVID, when physical comes back, will this stay or not? Right, that's a
Right.
great question to ask. But we actually take that a step further. We say that that might be temporary, but
Mhm.
then what the company is offering, does it have a fundamental long-term value to be made here? Right? Is there a longer thesis of 5 to 7 years where we believe that whether COVID or not, can
Right.
this company continue to exist and grow? And
Right.
that's the call we try and take, right?
Mhm.
Because we can't take a view on a 1 or 2 year situation because of COVID, which may or may not change. We don't, right? Will EdTech continue to grow? Most likely it will, but at what pace is anybody's guess, right?
Sure.
The same case for a lot of sectors. So we take a longer view. We take a longer view on what is the latent need in the market. Why do the founders and that company have a right to exist? And is there a 5 year horizon that I can see where this company will continue to do well and grow? And that's the call I take. And of course, right, COVID has sort of given massive tailwinds to a bunch of sectors, and we would love to look at those sectors and utilize that, right? Why not?
Interesting, interesting. I mean, I would honestly want to dig further on that, but I think we're going to keep it focused on the agenda for today, right? But I'm going to look forward to doing another session with you, Ravi. We're going to dissect this situation further more, right? But
Sure.
listen, tell me a little more about the liquidity situation, right? I mean, we've been seeing the kind of surge that we've seen in the last 1.5 years. We haven't really seen it, right? How are you looking at that? I mean, today a founder is spoiled with choice, right?
Yep.
There are, and if it's a capable founder or a team, there are many people who are willing to go down and sort of say participate in that round at a much better valuation, right? A very improved valuation. On one hand, of course, there's a huge value creation that happens for that team, right? Over a period of time, but that makes it difficult for you, right? How do you see that, Ravi? I mean, how has that, say, either made your job interesting or complicated, right? I mean,
Sure.
I'd love to hear from you how do you look at it?
Sure. Look, I think we've been around for a fairly long time in this business, and we have seen such cycles before. So I think we try and make sure we separate the noise from all of this. And you're right. I think there is massive capital flows coming in. The fact that China seems to be sort of restricting its own tech meant that a lot of institutional and large investors who were evaluating China will start looking at India as an alternative. And that probably also has resulted in massive capital flows, both in the public markets and in the private markets,
Sure.
right? So, in times of euphoria, I think we try and go back to our fundamentals, right?
Right.
Which is there a founder that we like and we believe are they the best fit for what they're doing? Do we believe in the long-term opportunity? Do we think that we make sense? And then also for us as a fund, Ashu, we don't participate in large fundraisers with a small check where we have minimal stake,
Right.
right? We would like to get a meaningful chunk stake in the company.
Mhm.
And if that construct isn't usually happening, which is a function of either valuation or the fundraise or demand, then we typically don't invest. We are happy to walk away from opportunities which don't fit our criteria. We don't invest in sort of themes that we don't believe in, and hence going back to basics helps us navigate in euphoric times where there is so much noise on all kinds of companies raising capital. Um, do we always find the right value at some of these opportunities? Possibly not, and we're happy to say no.
Right.
But what we would always rather over-index on the quality of founders than anything else, because if we think that these guys are the best founders for the product that they are building, then we're happy to compromise on a few other things, because these are the kind of founders who are best suited to navigate over the next 5-7 years, right? Because it's tough, right? I mean, building a business from scratch is hard, and high quality founders find a way to do it, find a way to raise more capital, find a way to get more believers in not just capital but also the high quality team, and hence it's always over indexed on founders. But also back to the basics, separating the noise and focusing on the fundamentals.
Ravi, I mean, across our conversation, right? When you've highlighted the need for backing a good founder, and I completely believe that. Right? I mean, that's the only constant that you can kind of really bank on, right? Especially when you're investing your money, right? But tell me this, right? I mean, I'm of course taking another, COVID-related situation, right? Or something that what it has done is that we're literally, as we're moving into uncharted territories, right? I mean, there are certain factors that are visible, but these are factors that might not be consistent and constant, right? And across many other conversations that I've been having, right? I mean, I've been having these conversations with promoters of very large enterprises. I've been having these conversations with CIOs, CDOs, many people in the business, who are taking decisions, right? Buying decisions on behalf of the company, right? I mean, there is little certainty that they're moving in, right? Do you think, and the skills required in an environment which now we're going to enter, right, is possibly going to be very different than skills that we require. And I'll give you an example of that, right? So, for example, your credit rating today is going to be far different in a post-COVID environment than the credit rating that you had in a pre-COVID environment, right? The way you underwrote insurance is going to be very different than the way you underwrote insurance in a different way, right? The distribution mechanics, for example, is going to change for many things, right? So we're talking about embedded finance, we're talking about embedded insurance. We're talking about a very different kind of an ecosystem, right? And again,
Correct.
like I said, there is no proven track record on that particular bit, right? Do you think overemphasis on a founder, on certain skills, certain experience could possibly just, you know, kind of catch you off guard in a certain environment? I mean, what are your thoughts about that, right? I mean, uh, to me, it adds to a further layer of complexity in what the call that you're taking, right? But how do you view that?
Sure. No, look, as an early stage VC, a lot of times we may not have enough data to validate anything, right? There may or may not be product market fit. There may not be a monetization.
Right.
There may or may not be a revenue model sometimes, right? What we have, right, is that the future is very uncertain.
Right.
And as a VC, one of the things that we get our arms around is to be able to deal with uncertainty. That is a huge skill which is actually very underrated. Not just in life, specifically for a VC, because you simply do not know how a certain company will play out, how a founding team will play out, right? Because like you said, right, I don't know what's going to happen in 2 years' time.
Mm-hmm.
The market is moving so rapidly, it's changing so dramatically.
Right.
But what is the constant in all of that is the founding team that runs that ship, right? And hence, a lot of time we spend on understanding, do these guys have the ability to steer the ship in such choppy, uncharted waters? And that is a conviction bet that we have to take. Right. Because if we don't believe the founders can do, then who else will?
Right.
We are not operators, so we can't run the company, right? Founders have to run the company. They have to sell the story. We are there, of course, to help them in every which way we can. But the buck stops with the founder. And hence, we have to over-index on the founder. We are a founder-first company, which also means that everything we do is for the founder, but that also means that when there are such uncertain times, right? Either we take a call that, listen, this sector, there is too much of regulatory uncertainty. I have no visibility on this, and hence I don't want to take a bet at all, irrespective of the founder. Right. But if you take out that, in most cases, it is hard to predict the future, especially at the stage that we come in. And hence there is, we always are happy to rely on high quality founders to steer the ship, because they are the guys who know where the opportunities are. How do you position a company? How do you sell the story? How do you attract capital? How do you attract talent? And that's just the way this works.
Interesting.
Because there is no way, I can't model the future beyond 12 months, right? Especially in the stage we operate.
No, I completely understand where you're coming from, and I understand the challenges that you face day in, day out, right? I mean, it's a difficult job, right? And I have complete empathy to sort of operating in an environment which is so unknown, right? It's so difficult, right?
Yeah.
And especially when you're not in the driver's seat, right? I think it just adds to the uneasiness, right? That could be there. Ravi, does that change the construct of your relationship with the way with the way you're investing? Is there a change that you, or it continues to be the same like the way you did earlier?
Um, when you say change, I think we look at a lot of sectors which maybe perhaps pre-COVID weren't on the radar
Sure.
because they, from a tech disruption perspective, they weren't up to the mark for us, and we
Right.
felt like it might be too early.
Right.
That has definitely changed. I think there are a lot more sectors where they're seeing strong tailwinds because of COVID, and now they are back on our radar from an investment perspective.
Right.
I think what has also changed is our ability to work closely with our founders. I think it's even more required for us that we put them first and we give them any and all support they require to
Right.
run their businesses. And we as partners with them. And several times I have rolled up my sleeves and done stuff in companies
Right.
to help them. Sometimes I tell my founders, listen, think of me as a free resource that you have,
Right.
and use me how you need to. Right? If you need me to sit and with the auditors to get your audit done, I will do that. Right?
Right.
So that's the message I give my founders. So it's just what has changed is it's just gotten us closer to our founders and our ability to work with them, help them, and give them everything they need to make the company successful because they're all aligned.
Interesting. Ravi, what are some of the sectors that have, you kind of mentioned about it, right? But what are some of these sectors that have, kind of reappeared in your on your radar, right? I mean, which are the sectors that you're now looking at, right? And I'm sure there's a change in thesis, right? There's possibly an amendment or an addition to the thesis, right? But what are some of the sectors now in a post-COVID environment or a post-COVID world that you're looking at?
Sure. No, I think EdTech always continues to be, and we have, now that we have invested in three companies, fairly successful ones, I think we have a fairly nuanced view on what we want to do in EdTech
Sure.
and what we don't want to do. Gaming, consumer internet, B2B e-commerce, fintech is coming back in
Right.
favor. I think there was a time when obviously it was a difficult time with NPAs
Right.
and the moratoriums, etc. But it's coming back with very interesting new B2B and B2B2C models.
Right.
We're also looking at some of the frontier stuff, especially in embedded finance, banking as a service within fintech, embedded insurance, etc. We're also looking at SaaS from a fresh lens. I think that we have done a few investments, but I believe like we can do a lot more,
Right.
especially in SaaS, and we're looking at that from a very specific lens, especially in the sort of India to the world corridor, because I think we think that's where the real scale is, at least
Right.
for now. So yeah, these are gaming I've already mentioned. These are some of the areas that we are very excited about. I think what we are also very keen, as always, is fundamental sectors within India's older sectors like manufacturing, etc.,
Right.
which are now getting disrupted by tech, and the adoption of tech has dramatically increased in the last
Right.
12 to 18 months, right? And we look at those models as well.
Very interesting. Ravi, I was in a very recent conversation, and I can't, while you were telling me this, I mean, I could just very quickly sort of that point referred in my mind. I was in a very recent, interesting conversation, right, with a VC based out of the US, right? And he said that, and of course, we were discussing about, the possibilities of ARPU for Indian SaaS companies, enterprise tech companies, which are offering to the customers in the US market, which is far more mature market and, pays a higher dollar, right? And then arbitrage is usually very exciting from an investor standpoint, right? Something strange that he highlighted, right, is that many companies that are operating in Western worlds are actually looking at a market like India, where they're not necessarily focusing on ARPUs. They're essentially looking at the possibilities of data generation, which is going to help them define the newer world, engagement possibility, right? Or at least helping them understand the consumer behavior in a better way, right?
Right.
And if that happens, right, it just makes it extremely complicated for companies in India which have raised a certain round of capital, right, on a certain story, to be fighting out against companies that have been far, which are far higher funded, right? Which are going to entering this kind of a market, right? Because I think what we're going to see possibly is a price war sort of environment. Do you think that's a reasonable fear to have, or I think these are just too very early, too early a time to be talking about and worrying about all of this?
No, I don't think that bothers me today because let's look at the Indian companies first, right? I think you're right. ARPU, as an example, obviously the West is far more paying than companies in India.
Sure.
But the catch is actually GTM, right? I think Indian companies build great products. What they really need to ace is GTM and the subsector within the larger US or the European markets that they're operating in. And they have to nail that GTM for them to be able to scale, right? For the companies in the West who want to sort of data gathering might be, it's not that easy because if you want to grow and scale in India, you have to make full conscious investments. It has to be a priority at the board level. if a company is at the, let's say, 300 or $500 million ARR in the
Right.
US, will India be prioritized enough for them to say, listen, we need to hire a team, a full-blown team in India. We need to grow. We need to scale. We need to have a team there. We need to dedicate resources for this, right? A lot of companies, it may not be on their radar. There might be some companies who will do it, sure. But for most of them, they're saying 20% quarter-on-quarter growth in the US, growing from 200 to, let's say, $400 million ARRs in less than 18 months. That always is a larger priority than a far-off market like India, right? And if somebody does put the effort to make the investment, then they deserve to get the benefits of it. But it's fewer than otherwise.
I like the way you put it. I think it's a little too early to bother about all of that. But listen, Ravi, I think I'm going to go back to the founder question, right? And I think this is something that I think both of us believe, right? It's a common constant, right? I mean, irrespective of whatever the situation is, the only way you can solve a challenge is through having a very good, capable, team which has the right, know-how, wherewithal, experience, right, and mindset. Uh, One thing that has happened, right? I think that we've seen post this entire liquidity event, right, is that many guys who are 10, 15 years, within their work, maybe higher, right, have actually been, very strongly considering moving out, right? Something that we didn't really necessarily see in the 2018 and before environment, right? But I think now we've started to see that, right? But another thing which is kind of a problem is that they are essentially looking to solve the problem with money, right? Do you think that's the right way to look at it, right? I mean,
How do you
is
mean?
this, and what I'm trying to sort of say is that, for their idea, right? They the aspiration, the understanding, and what they want to do is to have the money in the bank before they jump on to do something, right? Is that, and that's largely because of the liquidity event, right? So their understanding is that, there is a lot of liquidity which is available, right? What we're working on is we bring in the right experience, right? And there's an opportunity cost, right? And there should be money available for us to go out and do this, right? But do you think that's the right construct, or not so much?
I think very specifically for us, it usually is not the right construct, right? Because at the end of the day, we need to see what's the skin in the game for the founder, right? If he has an existing job and he says, listen, you give me funding and then I will quit, right? That obviously is a clear sign of message that he is willing to take very few risks.
Right.
And probably not the kind of founder fit for me. But I think that's a very myopic example because there's so many nuances to it, right? Like there could be founders who are on their notice period, they're already on their way out, but they're already raising capital, and why not? Right? They have every right to do that. So there are very nuances to that, but very simplistically, if funding is a backup as opposed to the whole and soul of your life, unlikely that we would partner with such founders.
No, but I'm saying, do you support that kind of mindset? Because there are certain,
who am I to support or not support? Everybody is their own wish. I can only tell you what we will and we won't do.
No, I like how you put it.
What I think.
Ravi, there is a huge conversation which is going on in Bharat, right? And like I said, I think a large part of what we are seeing is essentially because of COVID, right? It's just fast tracked the adoption, right? And in the consumer internet space, there is a huge excitement which is there around Bharat, and I think also the fact that you have now AEPS like structures, which are deep down, people have kind of adopted to fintech in a certain form and way, right? There is a lot of that which is happening, right? Empowerment which is happening in a certain. If that qualifies, to me it does. It's a very different appetite, right? And a lot of brands today, a lot of startups today are looking at that market, right? And are actually designing for that market. How do you dissect it? It's still, to me, it's still a market which operates at many layers, right? It's still a very complex market. It's still a market which has a baggage of culture, religion, right? Very local consumption, dynamics, so on and so forth, right? Are you equally excited about Bharat as an opportunity? How do you view it, right?
We are very excited, and if you see our track record, right, in Fund One, Doubtnuts, 90% of the user base is outside the tier one city for Doubtnuts. 90%.
Right.
Ziploan gives a significant chunk of its loan base to companies, SMEs outside the tier one cities, underserved markets. Right. Same case with business, BitClass, OneCode. We are very strong proponents of Bharat, and we believe that there is a massive opportunity out there. It just depends on what you're doing with Bharat. Right. And it depends on how you're playing it out. What is your GTM for Bharat? and how do you intend to monetize that audience? But
Right.
we are huge proponents for Bharat, and we have like 7, 8 companies. Metcod is operating only in smaller towns and cities, and they operate only in Kota and surrounding areas in Rajasthan and Madhya Pradesh. They're not in the tier 1 cities at all.
Right.
Right. So we're huge proponents of Bharat, and we very strongly believe in tech disruption across not just tier 1, but 2, 3, and slowly 4 as well.
Interesting. Ravi, that brings me to the next question, right? I mean, and that is related to Bharat, right? I mean, what we're struggling with Bharat when we talk about Bharat, right, is a low base of savings, right? Which essentially means that, the ability to consume, while there is aspiration, right, the ability to consume is limited, right? And that could be a huge deterrent, right? Irrespective of whatever incentivization that you do, right? It could still be a huge deterrent because there is little base that is there to go out and consume, right? The opportunity cycle is not, for example, as exciting, as large as it is in the urban areas, right? These are much smaller economies that are very, very largely dependent on small trade which is happening in and around them, right? While of course there's excitement, and I completely understand where you're coming from, right? I mean, would your thesis largely be around need and compulsion driven aspects, or would you still sort of navigate into saying that this could be an opportunity which could play out over a period of time, could be a trend which could sort of say become visible over a period of time, right? Are you okay with that, or are you essentially focused on, like I said, need and compulsion driven business possibilities?
Yeah, so spot on, right? I think I'll give an example, right? Business today has coverage across, I think, 30 or 40,000 pin codes,
Sure.
and 80% of it is outside the tier 1 cities, right?
Right.
And all these retailers in these small towns and villages, tier 2 cities across India, have an average order value of over 4,000 rupees.
Right.
So to say that they don't have the ability to buy is actually incorrect. I think the key is two things. One, what is the need that you're fulfilling? Is it a core need like education, like healthcare, like livelihood, like credit, which is required for them to survive? And that's where the pools of capital are.
Right.
The second is, what is your GTM and user acquisition? Do you have the ability to hit scale very quickly in a very smart way?
Right.
Because if you're going to spend money on user acquisition in a tier 3 or a tier 2 segment, then the CAC to LTV will always be a challenge. But if you have a very sharp organic user acquisition growth, and you're growing and you're engaging, then you have the ability to monetize this audience at scale. So that's the way we think of these things, in a very simplistic way. Of course, it all depends on what you're doing, but like I said, right, it depends on what core need you're fulfilling and how are you acquiring them. If you're going to spend 2,000 rupees on acquiring one user from a tier 2 audience, you probably will never make money.
Right.
And that number is only going to go up, right? So if you put these two things together, then essentially you have a magic concoction of large volume of tier 2, tier 3. You're fulfilling a core need, and hence they're willing to pay you money. And at scale, some of these numbers are very large, and you have an opportunity to build a very large business.
Interesting. Ravi, we're towards the end of the conversation. I cannot wrap up this session but to ask you a very cliched question, right? In a post-COVID environment, right? What are some of the say the top 3 or 4, 5 things that Ravi is going to look at, right? In a business, and you've highlighted some bit of that, right? But if somebody is to make a pitch to you, and I'm sure many aspirants are going to be watching this, I want to reach out to you post this entire interaction when we release it. What are the top 4 or 5 things that you are going to look at, and this could also be an advice to them. In terms of what do they need to prep for, right? And they could be young entrepreneurs, they could be seasoned entrepreneurs, right? What will that 4 or 5 things be?
Yeah, I think obviously, right, COVID has a macro level impact, and there might be sectors that are severely impacted right now.
Sure.
Travel is starting to come out of it. The lending, financial services are starting to come out of it, and we might want to go slightly slow there compared to some of the other segments, right? So obviously, one is what sectors have got tailwind because of COVID, and what sectors don't, right? That's an obvious sort of filtration in your mind. But the second is what kind of a positive impact in terms of tech penetration and adoption has had COVID on them? And are you sitting on those rails to grow, right? Which also goes back to the previous time in terms of tailwinds, right? So second, but I think after that, right, it's all same fundamental basic stuff, which is over-index on founders. Why do you have the right to win? What unfair advantage do you bring? What insights do you have? deck and storytelling is incredibly important
Right.
because at the early stage, till you hit maybe even a Series B,
Right.
you're essentially selling a future vision, right?
Mhm.
You need to have the ability to not just get investors to share your vision and hence part with their money, but
Right.
also be able to attract high quality talent who come with sub market salaries because they share your vision of the future and they believe that that's the way to go, right? So,
Right.
ability to tell a story, vision, attract high quality talent, unique insights that we may not have heard in the past before, and the ability to really sort of explain why why here, why now, and why then. And
Right.
ultimately, it comes down to these sort of real fundamental questions. Unfortunately, I don't have a fancy answer, but at least we are the investors who keep sticking core to our fundamentals and try and separate the noise. No
Ravi,
magic pill there.
Ravi, it was a pleasure to have you with us, right? Thank you so much for taking the time. I mean, I thoroughly enjoyed this conversation. I mean, I landed up saying this, right? I think after each of my conversation, right? And how I wish I could go on and ask you some more questions, right? But I think in interest of time,
Sure.
we're gonna close this one. And I look forward to having you with us, in some of the upcoming sessions, right? And which are going to be far more focused on just about pure aspects. We'll try and sort of dissect into some specific, topics, right, which could be beneficial for many, many people out there. Ravi, thank you so much for taking the time out. It was a pleasure to have you with us.
Thank Thank you, Ashu. My pleasure as well. As always, enjoyed the conversation. Got me thinking as well a lot of times.
Thanks, Ravi.